maybe you're someone who has their financial life in pretty good shape. You've got your cash flow in hand, you've got goals, you know where you're heading, and there's a bit of money left over at the end of each month, which you think you might like to invest. But there's so much information out there, so many people asking for your money, so many strategies you can follow. So where do you start? Well, here of course, because today on Money and a Good Life, we're talking about investing. Okay, I'm going to be completely transparent here. Everything I know about investing, I probably learnt on dates with blokes who do day trading as a hobby, which is why I'm not the expert. Ryan Watson is. Hello, Ryan.
Hi, Steph. How are you?
Not too bad. That might have been an overshare. My name is Stephanie Coombs, and we've got a fair bit to cover in this episode, don't we?
Yeah, and we know on this podcast we love an overshare, so I appreciate that. Maybe we can delve into that a little bit too.
We'll put that at the end. So, Ryan, look, let's start right at the beginning. If I wanted to begin in investing, I should probably be thinking about what I'm actually willing to lose, right? So what's a risk profile and why does it matter?
Yeah, thanks, Steph. Investing's an interesting one, and when the topic comes up, it tends to do a lot of people's heads in, overstated complexity, asset allocations, where should the money go, Australia or international based. So, to your question around risk profile, we really like to start with what risk appetite does someone have? So what risk are they willing to take with the money they're willing to invest? So it goes to your point around how much money they're willing to lose. Key elements of a risk profile is how long you've got to invest. And then the other key part is if there was an initial downturn after you invested your money, how comfortable would you be or how far would it go down for you to lose your comfort around and then want to pull your money out?
Right. So you should have a level in mind. How much am I willing to lose if it all goes bad?
Exactly. Generally it's 10, 15, 20%. If you're looking at taking more risk with how you invest, you would be looking at a longer investment time frame and would have some comfort levels around losing up to 20% of your investment at any point in time, recognizing that it's only a loss if you cash out. Time in the market will allow you to manage those ebbs and flows with investment returns.
Okay, so for me, for example, I'm someone, I think it's fair to say I'm pretty risk adverse. I'm also in my 30s though. Is this probably the time that I should be making a few more risky investments, whatever a risky investment is?
I think the key thing is start sooner rather than later, no matter what you're starting with, and then continue to do it often, if that makes sense. So as we touched on before around risk profiling, if you've got an extended time frame, 5, 7 to 10 years plus, then you can afford, in inverted commas, to take a higher level of risk. If you've got a shorter time frame, say 1 to 3 years, you might have a significant deposit for maybe a house. You want to take a lot of risk off the table and just try and get some returns.
If you're someone who is extremely risk adverse, even if you're young, if it's going to make you miserable, if you're going to be looking at your phone every 5 minutes and panicking every time it goes down $1 or $2, maybe you should just do something else. I think, is that fair?
Yeah, absolutely. As much as when we're looking at investing and discussing risk profiles, there's a big quantitative element, so looking at the numbers, but we really can't forget the qualitative overlay. So the sleep at night factor, if people lose sleep over it or look at it daily, that it's going to be detrimental to their mental health. So if they're not willing to take the risk, there are real options these days around being quite conservative in the way you invest, term deposits, high interest, where you can get 4 to 5%, which is a decent return given where interest rates are at the moment and where we've come from even in the last couple of years.
Is that something you shouldn't do? Look every single day? Because I reckon I'd be looking at the balance every 5 minutes. Looking
every single day is the enemy of progress. And what I mean by that, it can become all-consuming. We have clients from time to time who come to us and that's what they think they should do. And over time, in a really respectful way, we help train them out of that and relating it back to what their goals are and what's truly important to them in life.
Do you train them out of it by hitting them on the head every time they pick up their phone?
No, it's more care and coaching than physical.
Good.
Yeah, it's carrot, not stick. Okay. We really like the carrot stick. There is a saying, and I always butcher sayings, but it's something, a boiled kettle or something like that. So I think that saying is quite relevant to investing. It's know your risk profile, know how you're investing, and let it do its thing.
And don't check it every
Don't
seconds.
check it. Don't check it every 2 seconds. Don't check it every day. If you want to put a structure in place where you want to get updates, maybe diarise if it's weekly or fortnightly or even monthly, and then stick to that structure. That would be the best thing. Otherwise, you can get a bit of this like inspection creep, if that makes sense. You continue to look at it, a little bit like social media, and then it becomes omnipresent.
I have enough social media addictions, like Instagram and Twitter or X as we call it now. Like that takes enough of my time, I reckon.
It's a slippery slope. For me, in a professional sense, it's LinkedIn. Get
Really?
really sucked
That's
into the
worst
LinkedIn
one.
vortex. Yeah, I'm getting some eyes from behind the camera too, so clearly I'm on notice.
Yeah, LinkedIn is a weird one too.
It is the scroll, the messages. Everyone's like, a lot of people are trying to sell you things. I really like LinkedIn. I've got about 29,000 connections
Whoa, okay.
on LinkedIn. I found it's really good.
You know their names? You know all of them?
Yeah, absolutely. Birth dates, they're all on the Christmas card list. Absolutely.
Yeah, I think my favorite thing about LinkedIn is that sometimes you get like an interesting professional thing that's quite useful, and sometimes you just get like an off-the-wall meme or something that should be like on a group chat, and it's just a mixed bag.
I agree. I think there's almost two types of professionals. There's the ones that are overtly trying to sell you something, and then there are the ones that are really growth mindset and they want to better themselves and they want to share and they care about things in the world. So I think if you can learn to identify the second one, there's a lot of value to be had.
And then there are the ones who are taking like mirror selfies. That's the third group.
Yeah, exactly.
That's the weirdest group.
That is the weirdest group.
Now, back to investing. Sorry for that little journey we took there. So I've got a home loan, and at the moment I'm sinking all my spare cash into the offset for my home loan, and that's just about as far of a financial plan as I have. Should I maybe start diverting some of that money into investment?
We get this question a lot, Steph. We do a lot of financial wellbeing programs for small, medium and large businesses where we manage that wellbeing or the financial wellbeing quadrant of their wellbeing program. So we get a lot of these questions around that. Key thing with interest rates at the moment being around 6.5%, putting as much money as you can into your home loan is a very good place to start. Now, the reason being, if you were to look at investing, that investment would probably need to generate a return of 8.5% plus in order for it to be comparable to you paying down the interest on your home loan as well. So it's a balance. We love some diversification coming from paying down your home loan, but also investing outside. But if you've got a mortgage that's non-deductible, it's a great place to start paying that down. Yeah.
8%, that would be a very good return. If you had an investment that was sort of returning 8%, that'd be top end?
That's definitely top end in terms of long-term investment returns. That would be somewhere around like a high-growth investor, but we couldn't put our hand on heart and with any sense of certainty guarantee anywhere near that 8% return. Therefore, depending on the risk profile, but more importantly, levels of debt and comfort around that, focusing on a home loan first would not be the worst place to start.
And if you've got bad debt, for example, like a credit card debt, that's, I think we can all agree, bad debt, probably should be focusing on paying that off before you start dabbling in investments too.
Absolutely. Yeah, for sure. So, if you're talking credit card debt of 12, 14, maybe 20%, and you've got a home loan, great place to start would be paying off debt with the highest interest rates and work back from there.
So when you have your cash flow in hand and maybe you don't have a lot of debt or you're a renter and you don't really want to buy a house, that's probably when you should consider investing.
Yeah, absolutely. You should absolutely consider investing then. And the key thing around investing is finding good sources of information around education. We know we all go on a journey around things that we want to get better at. We start with courage and then we're at coping and then we're competent and then we build it to confidence. And it's not dissimilar to investing. So how can we educate ourselves and how can we go on that journey to confidence?
I just stay confused.
Yeah,
the whole time, just base level of confused.
You just included a fifth C.
Yeah, exactly, the confused level.
Now the 5 Cs.
Well, yeah, I'm getting closer to getting out of confused. This is helping. I think that's my next question, though, is it actually difficult to invest money? Because, as you said, finding the right information sources. If I Google it, I'm going to get so many articles from so many different people who don't just want to help me. They want to take my money. So I don't know who I should be trusting or if it's as complicated as it feels like it is. Do you think it's a complicated thing?
The short answer is it can be. The key thing is doing your own research, finding multiple sources of education. It's not dissimilar to life. So you go through life and you meet different people and then you find your crowd. So the same with investing as well. So do your research, understand what you like, what you don't like, understand your appetite for risk or your risk profile, and then find an investment source or sources that fit with your values. We find that, it's never been easier to invest, the likes of ETFs and indexing and things like that as well. So basically you get to invest your money into a very large pool of money. You get people who are very good at what they do. They don't charge a lot, and any profits that they make actually return to shareholders. They're mutual funds.
I think we're going to have to go a little bit more into what an ETF is.
Yeah.
So let's take it because we're talking to, this is the remedial class here. And I'm sitting at the back of the remedial class. So tell me what an ETF is.
So it's an exchange traded fund. So basically they take a pool of everyone's money and they do the investing on your behalf. That's it. So I think a lot of people are intimidated by when we talk about investing, how would I do it? Where would I do it? So finding the right platform, and then you've got thousands of investment experts who will do the investing on your behalf, and there's a lot of safety in numbers. So they're strong performing and they're low cost to invest and they're highly liquid. So you can get your money out at any time as well.
That sounds good. And when it comes to platforms, where do you start there? What should you be looking for when you say platforms for investing?
Yeah, great question. So you are looking at who's backing them, how transparent they are, what's the cost to invest, and also the user experience as well. So, we're all familiar these days with, banking apps and the like as well. Good platforms will have a really good interface, a really good client experience, and they will be largely low cost.
What is low cost? Do they take a percentage of your money or is it a flat out fee?
Yeah, so generally it's a percentage of funds. Low cost can be anywhere from 0.15 to 0.25% of what you're investing.
And if it's bigger than 0.25, you should probably look around somewhere else.
Shop around.
And you can shop around. I mean, it does just take a little bit of research.
That's the thing. It's about, pardon the pun, but it's about investing some time in your own education around it. Obviously, you could go to a financial advisor depending on how much you're looking to invest. But even then, it's always good if you do some of your own research and you get to at least, a base level of understanding.
I think depending on how much you want to invest is also a good point to think about. Do I need $20,000, $50,000 to invest? Or if I had $100, could I invest? Like, is there an amount of money where it's not worth your time?
Yeah, it's a good question. $100 is a challenge. $1,000 is more of a better starting point. I'm really, I'm a big one and I live my life a little bit like this. Why do tomorrow what you can do today? So start investing $1,000, and at that level, understanding, from your own personal cash flow, what you can contribute on an ongoing basis. And don't watch it too much.
As we've learned, do you have to keep on adding money into it, or if you just put 1,000 and then let it sit? You don't have to continue to put money into it. It's putting money into it on an ongoing basis is a good way to get a really solid compound effect. But if you're someone who's starting out and it's $1,000 and you want to see how it goes, and you might say, I'll put the $1,000 in for the first quarter or first half year and, again, build your confidence, it's a great way to start. And if, for example, I was someone who had a moderate risk tolerance, is there an amount where the money dips below where I should take it out? Or do you just let it sit? So should I say, look, I'm going to put $1,000 in, but if it goes below 800, because that's all I can really imagine, that I anything below that and I'll be freaking, should I set a hard line where I take the money out, or do you recommend people just let it sit? Yeah. If you're a moderate investor, the way I like to explain risk profiling is basically you have a risk rating from 1 to 10. A moderate investor would be about halfway, so 5 out of 10. 50% of your assets would be in growth assets, so Australian, international shares and some property funds, and 50% will be in defensive, so bonds, cash, both international and Australian-based. With that type of risk profile, you're looking at any downturn in the market of up to 10%. So if you invest $1,000,
Worst case, the markets crash, you might lose $100. So if you're not comfortable with that, then you probably should dial down the risk you're willing to take. That would be my suggestion.
So what should I be looking out for if I'm considering an investment? Should I be looking at the possible returns, or should I be looking at the risk profile, or should I be looking at both?
Yeah, I would start with risk profile. So getting one's own sense of how comfortable you are with the risk you're willing to take, and even pressure testing it yourself. That $1,000 scenario, if you were to lose 100, what would the comfort level be? If it was 150, if it was 200, and at 200, if you start to get really nervous, you're taking too much risk. If you're to lose $200 of the 1,000 or 20%, that would be somewhere like a growth or a high growth investor. So at 8 or 9 out of 10, therefore innately you'd want to dial down the risk you're willing to take. So I would spend the time on educating myself, looking at the risk profile piece. Then I would be looking at what platform to invest in, and then the underlying investments in the end. But what I'd be looking to do in terms of the underlying investments, diversifying with a big investment house and let them do the investing. I wouldn't be picking individual stocks or anything like that.
Now, I mentioned this right at the top of the episode, day trading as a hobby. I've had to hear a lot about day trading. If there's something that blokes on dating apps love, it's day trading.
And why do we think? Steph, why is that?
I don't know. I reckon maybe I need to change my location for where I am. Maybe it's just
what is that location again?
Bondi. So maybe this says more about where I live than men of the other gender. But I reckon there is something about day trading which some people really love, right? Which is, correct me if I'm wrong here, but it's where you're making big trades on a day, on a vibe.
It is your job. That's what you do. You look at overnight markets and you trade based on you having an interpretation about markets going up or down. Somewhat you know better than most, and you can make a living or significant amounts of money off the back of it.
To me, that when you're going into day trading, and I think that some people think this is the quick way to wealth, to me it feels a bit like gambling if you don't really know what you're doing.
I really agree. There's an analogy that we use at Tribeca, the tortoise and the hare. Particularly when it comes to investing, the tortoise wins because it's the slow and considered, the power of compound interest. And there's a whole other podcast, Steph, in terms of compound interest. That's
financial planners love compound interest. They love it.
I love
so
me some
much.
Compound interest. Yeah. Exactly right. So, but it's the tortoise versus the hare. The reason being the hare gets distracted. The hare wants to sprint. The hare doesn't stick to the goals nor the strategy. The tortoise, it's the slow and steady that wins the race. I believe it's a great analogy for investing.
And I think that that's something that people should probably think about. If it sounds too good to be true, or if you just want to turn a bit of cash around and make a lot of money, it's not really what good financial planning is.
No,
you guys are all about making sure that you make the right decisions in the long term for a better life in the long term.
It starts with goals. So if we're all going on a journey, do we want to go to Brisbane or do we want to go to Perth? So we need to know what the long term is. And then the strategy really sits in what are the stops we're going to make along the way? Like what's important to us on that journey? What are the stops? And we underpin that with a financial strategies around, smart cash flow management. How are we investing inside, outside superannuation? And do we have the right contingency planning off the back of that too? Things that we never like to talk about, but life insurance, income protection, and also the big piece, the she'll be right factor in Australia around estate planning, wills, testamentary trusts. A lot of people we see don't have their house in order around that, or if they do, maybe they implemented something when they got married, but it's not current. They might have family trusts. They might have, they might be on a second marriage, blended family, kids. Estate planning is one that, as Australians, we really need to get our house in order.
It's funny as well. Like, it's not sexy, is it? Long-term planning, what are my goals, what are my estates or whatever. But, the future comes around so much faster than you think. What do they say? The best time to plant a tree is 50 years ago. The second best time is today. You do actually have to start and know that future will come around quite fast. And it doesn't take long, I think, for the ship to start to turn if you make the right decisions. You'd be surprised how quickly it comes around.
Yeah, exactly right. And, like anything in life, it's good habits. So in this instance, it's good financial habits or good financial hygiene. And as I said earlier, it's don't do tomorrow what you can do today. So it is about just starting and building your confidence. And to your point, Steph, it's amazing, when you see people build their financial confidence and they start with I can't, then they go to I can, and then they're empowered and they build this financial strength around this financial confidence, and then they're in charge of their money. And it's just a completely different perspective.
Are there common mistakes that you see people make when they just decide, all right, I reckon I'm going to go into investing? What do you see people doing over and over again that you'd like them not to do?
Yeah, I preface this by saying without judgment. A key thing is, we'll see people that have been at a barbecue and let's say Kevin or Gary, let's just choose a name, right? And they're experts, right? And it's about the next investment property or it's Bitcoin. This is the key thing. But particularly, around investing or property and the story, someone's brother-in-law did something and then that worked really well and I need to do it. And they got the tax deduction for that. But the thing is they don't understand that individual situation. They just read the headline. They didn't read the article. So that's the key thing. So mistakes we see around property and then people just wanting to do something but not understanding the underlying around it. So there's a couple of horror stories around that. And then the key piece around the likes of Bitcoin, once again, they read the headline, they see the returns. If only I'd invested $100 in 2011, it would be worth millions of dollars now.
Yeah, if only I picked the right lottery numbers the week,
exactly
last
right.
week.
So they don't truly understand the risk. They just see the return and they dive straight in because it feels good at the time. Doesn't always lead to the best results. I
have a mate who, smart person, but he was at a pub. Someone was like, "Oh, you got to get onto this."
Was it Kevin or did he know? Was Kevin or Gary at the pub?
It was one.
Right, okay.
It was a Kevin or it was a Gary, and I think he was a few schooners in.
Yeah.
But this guy was like, "Oh, look, I know what the next Bitcoin is, mate. You got to get onto this. You got to get onto the next Bitcoin." Gave him some name. This guy was like, "Oh, I have to get onto the next Bitcoin." Sunk his money into it, bought it at the peak, immediately dropped the next day. But there's something about, you have to be so careful with recommendations because people are so convincing because they believe it.
They are.
And we trust people's recommendations so much. But, I was like, you're a smart dude. What are you doing taking your financial advice from some plugger you met at a pub 5 minutes ago?
Exactly. And I do preface this by saying that if you have your financial house in order and you've done the work on understanding investing, it doesn't mean that you can't apportion 5 or 10% of your investment portfolio to some speculative investments. Gary gives you, say, a tip. You go and then do your research. And if you're then convinced off the back of it, you can invest a small portion.
Small portion.
A small portion. The challenge is people go chips in because they want the investment to do the heavy lifting as opposed to them building that financial muscle or having the right habits.
And it's that FOMO as well, that fear of missing out. It's because you don't want to miss the next Bitcoin or something like that. But I think it's take a few deep breaths, research it, think about who you're talking to, count how many beers he's had to drink, and then off the back of that, decide whether or not you want to follow their financial advice.
Exactly. And it comes back to, we've talked about it, running your own financial race, understanding what's important to you, and then making informed decisions around that. I think you mentioned, Steph, then around FOMO and so many people making decisions about somebody having their house in order or the car they drive at the school gate or where they're going on holidays. But whatever the family unit looks like, focusing on what's important to you in life, then building the financial plan around that, that's the key.
Beautiful. I'm going to take all of this to my next date. So I was like, we're talking about day trading. It's like, well, I have some investment tips for you, my friend. Let's talk about risk profiles. They'll love it. Can you believe I'm single? This is insane. Ryan, again, thanks so much for your insight. I reckon that's probably a really good start for anyone who's listening. I feel like I learnt a lot.
Great.
I feel like you probably learned a little bit too much about me.
No. It's always good to learn more about you, Steph. And the piece around investing is a lot of people probably know a lot more than they actually think they do. It's just finding how it works for them and doing some self-education as well.
Beautiful. And if you want more money advice, make sure you follow this podcast so you never miss an episode. We'll see you again soon. Advice given in this podcast is general in nature and is not intended to influence decisions about investing or financial products. Our listeners should always seek their own professional advice that considers their own personal circumstances before making any financial decisions.